Welcome to the 2024 Economic Preparation and Depression channel. I'm your host, Tony. Thank you for joining me on this April 3rd, 2024 edition, midweek Wednesday. And we're going to be talking about the payrolls and if an interest rate cut could be coming by July. Now, this is all possible. Please be sure to subscribe to this channel. Preach to me for the latest interpretation of financial news as it becomes available in the media and elsewhere. Appreciate you guys' support, and ladies and gentlemen, I read all of the comments, and I appreciate you guys walking with me in 2024. So we're getting right into it. Private payrolls increased by 184,000 in March. Now, this is better than expected, according to ADP. Now, ADP is the job source that many people use, along with the BLS, the Bureau of Labor Statistics. So this is good news. This is actually good news that we're reporting on this front. Companies added 184,000 workers on the month. That's an increase from the revised gain of 155,000 workers. Now, the question would be, obviously, what type of private payroll jobs are we talking about here? And you remember a couple of months ago, or even a year ago, you would see these buses with these signs, or even semi-tractor trailers with these signs saying, now hiring. And a lot of people, you guys were telling me, ladies and gentlemen, in a lot of parts of this country, you were telling me that they were using that as a database. Like, they would put these out, and a lot of young people would go there, whether it were high school, college students, or maybe even just, retirees would go there and apply, and they were just building up a repository of applications. They weren't actually hiring. Maybe they were hiring like one or two out of 100 applications that they had on the database. They were just building up a database. Now we're starting to see that more again. Wherever you look on tractor trailers, vans, on storefronts, you see this now hiring thing. It's almost like it's just a sticker that they put out there. So according to this report, private sector job growth expanded in March at its fastest pace since July 2023, indicating continuing buoyancy in the labor market. So the labor market, they're claiming in this article and in the media that it's holding steady. And that means that what they're basically saying is that not only is that the wages are keeping pace with the inflation, or sort of keeping pace with the inflation, and they're saying that the job openings are keeping pace with what's going on. So what happened is the job gains, what they're saying in this article, is led by leisure and hospitality, which is no surprise because the United States is a service-based economy. It's transitioning to a tech-based automation, autocratic economy, but we still have a service-based economy here with the leading sectors. Construction, 33,000 jobs. Utilities, 29,000 jobs. Education and healthcare with 17,000. And professional and business services saw a loss of 8,000. Now, I did mention, I wonder how many government jobs were added in this total here. We would have to find that out later, but right here, that's what here it says right here. Okay, it says whose survey is based on payroll data analysis of more than 25 million workers, but does not track government jobs. So interesting. I wonder what that comes from. So anyway, the ADP estimate is just a precursor to the Labor Department's non-farm payroll survey set to be released on Friday. So Friday, I showed you the calendar in one of the earlier videos for the month of April, the financial calendar, what we have scheduled for the United States. And so on Friday, they're going to get the non-farm payrolls, and that's going to be very, very important. This article says central bank officials, as I've been telling you, expect to cut interest rates later this year, but have said in recent days they haven't had enough evidence to see that inflation is on a sustained path to lower to begin reduction. So when do you think they're going to cut rates? Fed Chair Jerome Powell says that it's too soon, quote, to say if their recent higher than expected inflation is just a bump. Now, in my humble opinion, I believe that it's not just a bump. This inflation is here to stay, as you know, and gas prices are going to go above $4 a gallon for most parts of the country, if not all, during this summer from June to July and August. And also, it's not going to be that. Food prices are going to stay elevated, as you know. Utilities are going to stay elevated. Light bill, cable bill, phone bill, stuff like that, gas bill. All of that's going to stay elevated. So right now they're saying, look, they're playing it by ear. They don't know if they're going to raise rates by June or July. And he said that, quote, there is no rush to cut interest rates. Well, that may or may not be true, ladies and gentlemen. But the problem is that the borrowing power, when you raise interest rates and when you don't cut them, but instead you raise interest rates, which many people fear is going to be happening, that cuts into the credit limits, the substantial personal and commercial credit of a lot of these companies and a lot of these businesses. And that means they start getting ready to think about layoffs, because how can they meet operating and payroll costs at the same time provide a quality product to the American people when they have these higher costs, input costs? You see what I'm saying? And so this is what could be happening, ladies and gentlemen. Right at this moment, financial markets are expecting a 25 point basis cut on June 12, although the odds are not far above a 50-50 split. Economists see a real risk that the Fed will push a rate cut from June to later in the year. So my guess is they're thinking, like I said, once again, this is what I've said in the previous video. I don't think the rate cuts is even coming. Even the 25 basis rate cut is not coming until after October and November, after the elections season. Unfortunately, by that time, it may be too late to get on the bandwagon of rate cuts, and the damage will be done. By that time, we will be in a recession. We're already in a recession, but officially on the media, you'll start seeing that they're going to start saying, oh, hey, we're in a recession and blah, 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 blah. So look out for that. Okay, so now, another thing to worry about is the gas prices. Yahoo Finance says that ExxonMobil signals weaker oil and gas prices to hit first quarter profit. Well, this is behind because now prices have gone up. As you know, they're going up above $80, $90 a barrel. But during this time, prices were down somewhat. Gas was holding down. The average, according to AAA, was down to like $3.40 or $3.20 a gallon. But now it's starting to accelerate upward as we head toward the summer months, the all-important travel season for a lot of students and parents and etc. So now the essential travel will continue to impact this area. We can expect to see, once again, all of the essentials, prices and all of the essentials, once again, is going to be going up into hyperinflation for America and the Western world, Europe, and all of the G20 nations, the big nations, okay? All of the non-essentials, we're going to see deflation initially. Now, totally, in the Great Depression, we've had was hyperinflationary, but this is totally different. Since this is a worldwide depression, what the United States is going to be leading, be the last to feel the effects. We're going to experience first a combination of hyperinflation and deflation as people run out of liquidity, money, the cash becomes, worthless or less valuable. Okay, and then eventually we're going to experience a massive deflation. But by the time we experience the massive deflation, no one will have any extra liquidity because we'll be under some type of universal basic income, right? So we'll only be able to pay for our essentials inside the system, those of us who are inside the system still. And then the rest of us who are, and the rest of the money will be taken up by non-essential needs, and we won't be able to, spend anything extra on discretionary income. We won't have much discretionary income, even though it's going to be eventually going to be a deflationary type economy, even with the technocratic, stuff coming in. So that's what we're looking at in the future. But right now, we have to get through the initial shocks that they're going to put through the system, and the stock market, the bonds, the derivative market, the credit market, all of that's got in the housing market, all of that's got to go down and crash, and then they'll like I said, they'll come in with the Great Reset and all of those things that many people on other channels have been talking about. But in the hyperinflation situation, obviously everything goes up: gold, cryptos, houses, bonds, and all that. But it's a temporary surge because of what's going on. Is they're printing up more money on the front end to pay for all of that, and that devalues the currency. But eventually it catches up, and deflationary happens because there's too much products out there and not enough liquidity in the system for the average American to sustain themselves. So there's something to look out for. Continue to be prepared. Continue to stack canned goods, perishable goods. Continue to get food, water, medicine, the basics. Take care of the basics, and then security, and then worry about everything else. No matter how much stuff you have saved or how much stuff you prepared, no one can ever be totally prepared for these big shocks because we've never seen anything like this before. On paper, yes, we've read about the depression, but many people have not lived through some type of depression. And this is going to be different because, like I said, this is worldwide, number one. And number two, the type of hardships that we're going to experience is totally different than the depression because now we live in this age of technology and information. So it's going to be different, but some things are going to remain the same. They're just going to be calling them by a different name. So be on the lookout for all of that. We're just getting started. I'll talk to you more soon on Friday when they come out more with the different reports that's going to be happening. Once again, the non-farm payrolls come out on Friday. The jobs report comes out Thursday morning at 8:30 Eastern time, I believe. So we're going to see all those numbers in terms of see what they do. But everybody knows in this economy, or should know, that the unemployment is much higher than what's being reported. We know that inflation is much higher than being reported. And we also know that, in the natural business cycle, you can't be up on the business cycle on the expansion curve for over 13, 15 years, 20 years, and nothing comes down. What goes up must come down. That's just basic laws of physics and gravity. So look out for that. Be safe, be blessed. I'll talk to you very soon. Thank you for listening. Bye-bye.